Hidden dangers are exposed. I'm your host, Steve Van Metre, and thanks for joining me today. In our lead story today, a Just Leak report shows us what could trigger the next liquidity crisis. And this is something nobody will see coming due to the sheer complexity of the global financial system. And the fear here is that this has the potential to unwind faster than anything we have seen throughout history that could cause an unprecedented liquidity crisis. But before we get to that, let's head over to Bloomberg, where we picked today's story up with a headline: Evergrande liquidation ruling postponed in surprise to creditors. And while this does a surprise to creditors, it really shouldn't be a surprise at all, because in good times, what happens is you can go to liquidation and you can actually find out that things aren't really actually undervalued as much as everyone thinks. And so there's a huge risk here, because we talk about how the Chinese property market is insolvent. Their developers have major financial issues. They are losing money. They need injections of credit in a major way. And due to how much money is tied to the Chinese banking system, well, if the property developers go down, the banks follow suit. And it's not just the banks, as you're here going to see in a little bit. There's even more people at risk. So the problem here is we know that Evergrande has been trying to sort out their issues with their creditors. If a judge deems that this cannot be sorted out and it sends them into liquidation, you can think about the domino effects that happen here. Because in liquidation, during the times when we see global dollar shortages and we see a global slowdown in the economy, what you find out is just how little things are actually worth, and that could cause then the banks to be forced to write down existing assets, prevent the developers from getting money, and kick off what is already inevitable, likely to be a global financial crisis. So the steps here are at big levels, because we know the courts don't want to do anything that causes a systemic meltdown. And yet China Evergrande Group won some breathing room to strike a restructuring agreement with creditors after a Hong Kong court again pushed back on a decision on whether the world's most indebted property developer should be wound up. Now, wound up means have a fire sale on the assets, liquidate the company, and pay creditors. Granted, they're going to get pennies on the dollar, but they're going to get something. The problem here is we don't want to find out just how little these assets are really worth. The proceedings have been adjourned to January 29th. The unexpected delay came as the original petitioner didn't push for an immediate liquidation on Monday, or an about turn that caught Evergrande and other creditors off guard and marked the latest twist in a lawsuit that has dragged on for more than a year. And again, you see the fear here is you send Evergrande into liquidation, you find out how little their assets are worth, and then you're forced to see banks have to write down other assets. You're going to see other creditors at other companies flee in a big way. You're going to see investors yanking their money out, and this has to get settled. And that's why the courts don't want to be the one that kicks this whole next crisis off. And China's property slump is deepening despite policy measures to put a floor on the market slump that began 3 years ago with a crackdown on the industry's reliance on debt. And there you have another reason why you don't put a company in liquidation when things are bad. You put them into liquidation when everyone's booming and willing to say, hey, you know what? I could use some of those assets, and I'm willing to pay maybe not top dollar, but somewhere close to that. Everybody comes out a winner. But with what's going on in China's property market, the risks just are too high. And the International Money Fund warned earlier this year that the trouble could spill over to the financial industry, as we've been pointing out on our show here, and local government if confidence is not restored. And that's what the courts need to do here, because as you'll see here in a little bit, this risk in China's property sector isn't just the banks. There's so many other people tied into this that it is a major deal. But one thing we look for in terms of if the question is, are we headed into a global slowdown, a recession, potential financial crisis? Well, we have to answer the question, do we continue to see signs of money shortages throughout major industrial economies? The answer is yes. And what we're looking for are things like insolvencies, defaults, and delinquencies, and a big one just hit. As Cigna and last-ditch funding talks as insolvency wave looms, ooh, that's bad news, as one of the sprawling conglomerate founded by Austrian tycoon Rene Benko already filed for insolvency. This happened on Friday, and further notifications may follow in the coming weeks. This is a problem. This is exactly what happens when financial systems start to run out of money. You see more and more headlines of delinquencies, defaults, insolvencies, all indications that if you're looking for the thought that perhaps we're going to have a major bull market here, maybe stock prices are going to go to the moon. Well, when you start to see insolvencies, that tells you the financial system is getting one step closer to blowing apart. Delayed efforts and internal doubts underscore the precarious situation for Cigna, which risks becoming one of the most prominent victims of turmoil in European real estate markets due to rising interest rates and diving real estate valuations. We touched on this last week. I said, wait a minute, this commercial real estate problem isn't just an issue here in the U.S., it's an issue now in Europe and potentially in other places. Because Benko used to ground his strategy on the idea that only the Catholic Church and the Queen of England can boast a comparable portfolio of unique locations, meaning Cigna was buying up properties that are now not worth what they're supposed to be worth. They're going into insolvency, and you're going to see more and more of this in the future until something in the global financial system snaps and everything comes crumbling down, along with interest rates. But one person who's standing strong is the People's Bank of China chief. He pledges to keep growth of the money supply in check. And what we're pledging is to help you grow your trading account. Now, many people say, Steve, I'm still struggling. How do you use your reports? Things are going down today. How do we do this? Well, let me show you. I'm going to give you a perfect example of something that just triggered the other day. You got to find it in the reports. It's so easy. Check this out. Let's go to our CTA Timer Pro. We talked about on Sunday why machine positioning matters, because it can drive markets in a big way. And what do we know? Back on November 28th, wheat triggered down to a sell position of a minus 55% short. Now, what you're looking for here, what we show our subscribers is when you see this, you look for a corresponding move up off of it. Lo and behold, it happened the following day. Now, you could just trade this report on its own, and many people do. But some of our most successful traders pair it with our other report. But again, you could trade this on your own. That's the first signal you're looking for. Let's take a look for the second signal you would want, just from our Momentum Timer Pro, that takes all those technical indicators that people find so confusing, smooths them all out, and gives you one signal per day on these securities. It shows you momentum swing positive on wheat. It was negative the prior days. So on 12/1, we have our now confirming signal. Remember, we got it on CTA a couple days prior, but had you bought on 12/1, that would have been Friday at market open, well, you'd be up 6.1% right now on that trade alone. Talk about the potential to pay for all of your research for a year. One trade can do that. That's the power of those two reports. And for those of you looking to get in on that free month, well, again, thanks for all the birthday wishes. Let's continue that going on. 3 more coupon codes, each for CTA Momentum Timer Pro, for a free month. Get them before they go on. If you email me, say, Steve, I can't find them. It's because 3 people beat it for you. All right, check it out. Let's continue on here, because the People's Bank of China reaffirmed they're going to keep control of the monetary sluice. This in a recent article. And what we're seeing here is officials have used the language in the past to underscore the PBOC's desire to avoid massive easing leading to a rapid buildup of debt. Now, that sounds a bit confusing here, because what we face in issues, there's a lot of people that believe in the money supply. We call them a money supply monetarists. They think that thing matters to everything. They think it links to inflation. They think it links to stock prices, that somehow money sitting in the commercial bank, in your bank account, magically causes inflation or magically causes stock prices to go up or down. And yet, I don't really believe any of that at all. The problem is central bankers, well, they believe it a lot. And here's the evidence as we look at the U.S. money supply. That's the M2 against the Consumer Price Index, shown in red on a year-over-year rate of change for both of them. And if you're looking at those lines and saying, Steve, I really don't see a lot of correlation. Well, good news, because you don't. What normally happens is people say they go together or they go together with a lag. But every time you try to line them up, it doesn't work. And you can see cases where the money supply is coming down and inflation is rising. That's not how it's supposed to work. It should be the other way, that when the money supply is rising, well, inflation should rise, but sometimes it goes down. And here you can see that again around 1980. In fact, you can even see it here in the mid-1970s. You can see divergences here during the dot-com bubble, the global financial crisis, or even now, we saw the money supply start to come down on a year-over-year rate of change. And what happened? Inflation continued to rise. So all these people that hold tight to the money supply, including these central bankers, well, they just don't understand. It's probably one of the most meaningless data points we have out there that some people get really excited over. And the language indicates the PBOC will, quote, unlikely let loose the floodgate of credit and will instead optimize the quality and structure of credit. The central bank may utilize more structural policy tools to guide funds into targeted areas. Okay, so this is a major problem here, because notably here, let's look at this article and it says, let loose the floodgate of credit. Now, in a debt-based economy, if you want to see your economy grow, you need to create new money. You create it through the commercial banking system, and you need enough money not only to hit the growth targets you want, but to support your existing debt levels. So what do we know about China's economy? Well, it's slowing in a big way, and they can't stop it. And their property developers are insolvent, which means the banks are insolvent. And as you're about to see, some more people are actually insolvent. And then we've got problems, of course, in Germany, US, with our commercial real estate markets as well. But so what would we want to see is an expansion of credit. Well, we're not getting that at all. And here's the evidence as we look at the U.S. data. Commercial industrial lending, shown in blue, will keep the consumer price index on red, both on a year-over-year rate of change. Commercial industrial lending going negative. You want to see a relationship? Well, when commercial industrial lending is expanding, what happens? You create money in the system. Money leads to getting into people's pockets, creates demand. That money gets spent, and you get inflation. So notably, everyone says, look, we're going to have a resurgence in inflation. Not when you see a contraction in commercial industrial lending, because here's the key thing that central bankers around the world and the PBOC doesn't get either, that when you have an expansion of new money, it creates. So commercial banks create new money when they originate a new loan. Guess what happens? When that loan gets paid off, the money gets destroyed from the system. Only the interest stays. And so you start thinking about, wait a minute, we were just in a zero interest rate policy for a long time. That's right. And that means a 0% loan, if it gets paid off, no money stays in the system. That's the danger here, is you see accelerations to the downside when you see commercial industrial lending contract, particularly from a low interest rate environment. It says money is getting eviscerated from the financial system, and that means less money to support growth, less money to pay on the debts, more insolvencies, more delinquencies, more defaults, until everything blows up. That view is in line with the central bank's recent guidance for banks to cap the amount of new loans they issue in early 2024 and shift some forward this year. So I want you to see the mistake that PBOC is making at a time when they should be encouraging lending because they need new money in the system. But why can't they do that? Because the yuan has fallen in value. And we talk about how central bankers and these political elites do not understand how any of the system works. The reason the yuan is losing value is because global trade is falling and nobody really wants it. There's not as much demand for it. And so they're thinking, wait a minute, if we have a whole bunch of new loans, this creates new money and further devalues the yuan. That isn't the answer. What you need to do is get people out there borrowing money, creating new money, getting new business going on, getting demand for currencies and commerce, and that will lift the yuan up. They don't get it here at all. And yet here we see an analyst who called it Chinese bank turmoil, says trusts are next. So again, we talk about how everything in China is going wrong here, and yet we see more and more problems starting to pop up because there just isn't enough money to support everyone. And what did we just hear from Beijing come out and say through their central bank is we're going to cut the amount of credit created. That is the worst possible move they could make. Right now, they're planning to send their economy spiraling into an abyss. as many of these firms are deeply distressed, potentially with their capital solvency as risk. You talk about problems. Here we have again distressed solvency issues, and wait till we show you what could trigger the next liquidity crisis. Cracks have already appeared in the sector, which has lent extensively to troubled real estate developers. Missed payments from Zhongrong International sparked protests earlier this year, while the industry saw its first bankruptcy in May when New China Trust folded. So here we have an issue of, again, more signs of a lack of money in the system. And what do you see? The PBOC is going to limit the creation of money. It's going to mean that there's going to be more insolvencies, more defaults, more problems. They don't realize that it's not about the value of the currency. It's about creating new money to pay on all these debts. And that all tells us that we are actually going to see at some point a massive liquidity crisis, not too different than what we saw during the 2008 and 9 global financial crisis. But what's different now is the financial system, as you're about to see, is far more complex and can unwind even faster than anything we've ever seen before. As margin calls from clearinghouses are now seen stoking future crises, and this is what we're doing at the Bureau of Labor, not the Bureau of Labor, the Bank of International Settlements, the BIS, not the BLS. That's a little different there. Central clearinghouses that hold over $1 trillion in liquid assets may exacerbate periods of financial stress, creating margin spirals. Notice that word, spirals, that can push down asset prices, this according to researchers from the Bank of International Settlements. So now what we're hearing is that in a point where we have a shortage of money, which we have now, and that's what we talk about, what's going around the world right now, and you see these inverted money curves, these inverted yield curves by the central bankers. They started this whole thing by constricting the creation of new money. Then you see the PBOC say, hey, you know what we think our solution is? We'll further constrict credit. And all this means is it leads to a liquidity crisis. And that's when finally everything comes to roost and there isn't enough money in the system, and everything then gets mechanically unwound, in this case, spiraling out of control. The researchers focused on the impact when central counterparty clearinghouses, known as CCPs, increase initial margin requirements for its members during times of stress. So this, what happens is people that borrow on margin during times of stress, you think about, I'm borrowing money from somebody, I give them perhaps a small amount of money in terms of a larger amount of money that I'm borrowing. And at some point they say, Steve, we're a little worried that you might not be able to pay that loan back. So we want a little more capital. We want to increase the amount you have on margin with us. So we need some more money. And all of a sudden I'm saying, wait a minute, I don't have any access to more money. There isn't money out in the system. And that's the issue here, is that creates a time of stress and everything starts to unwind. And this may lead to fire sales in cash and derivative markets as investors dump assets to raise the needed funds. So you get margin called here, and what happens is you say, well, look, I don't have the cash, I don't have access to it, no one wants to lend it to me, I don't have anywhere to turn, and that forces a fire sale. So you start to think back to our original story of Evergrande. Why don't the courts want to just say, hey, you know what, go to liquidation, let's find out what happens? Because you have a fire sale, you find out just how little things are worth when there's no money in it. Well, wait till everyone's having a fire sale. Imagine everyone in your whole neighborhood having a yard sale at the same time, and then every neighborhood next to you and everyone after that, everyone is having a sale, and that means prices come crashing down and spiraling out of control. And this could lead to, of course, increasing volatility and triggering additional rounds of margin calls, suggesting that the whole system is in very fragile state. As CCPs currently manage a large pool of liquid assets, which supports financial stability by safeguarding them from counterparty risks. At the same time, risk does not disappear, but morphs into systemic liquidity risk, especially in the context of margin spirals. So we can see this happening here in a very easy way, because we know we're seeing a continued contraction in credit. We're seeing liquidity out of systems evaporate. Now, normally there is liquidity, there's money flowing in the equity markets. We could see that right now, but broadly speaking, the financial system is running on fumes. At some point, it's going to come breaking and shattering apart. Meanwhile, clearinghouses require that its members place collateral to protect against counterparty risk. But you think about what collateral is, the article goes on to say, but by means such demands can create liquidity risk as traders push into high quality liquid assets. Well, what's a high quality liquid asset? That's what's called a treasury bill. They're one of the safest, most liquid instruments. And what happens? The U.S. government issues a bunch of debt and then they go refi it at longer terms. We don't have enough T-bills. We have plenty of debt. We just have it structured in the wrong places. And what happens is all of a sudden everyone has a rush for collateral because they're getting margin called. There isn't enough collateral. Everyone wants it. It drives rates down. All of a sudden you see short-term rates, intermediate term, long-term rates coming down. The Fed panics, they start cutting rates. All the other central banks panic, they start cutting rates. And next thing you know, there's an all-out crisis as everything comes unwinding in a big way. And now you're seeing that this could cause the next major liquidity crisis. And we're already seeing a slowdown here in the U.S. as U.S. factory orders now have plunged the most since COVID lockdowns in October. The chaotic time series of U.S. factory orders was expected to swing to a big loss, minus 3% month over month in October. However, factory orders tumbled even more, down 3.6%, the biggest drop since COVID lockdowns back in April 2020. We said, look, we've told you this was a matter of time before the government data was going to catch up with the factory data from the regional Fed surveys. Here's the evidence. Here we have the current general activity. This is the diffusion index from the Philly Fed manufacturing survey against the headline government manufacturers' new orders of durable goods. That one in red. Red is on a year-over-year rate of change, and we've noted that at some point this thing's got to come down, and now it's coming down in a big way. You can see the official government data in red follows with a lag the survey data that we get from the regional Fed. And here we go. The big monthly decline in revisions dragged orders down 2.1% year over year, the biggest drop since September of 2020. Core factory orders also dropped 1.2% month over month, leaving them down 2.2% year over year, the 8th month in a row of annual declines. And what does all this mean? Well, when demand starts to go down, when factories start to slow down, what do they do next? Well, if you said lay off, you got it right. We're going to have a payroll report coming Friday. All eyes are going to be on that for sure because it tells us liquidity is draining out of the system. It's only a matter of time before we find out just how messed up our global financial system is in terms of what all these central bankers and big banks have done. And if it comes unwinding in a rapid way, well, at least now you know what could happen. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.